Hello everyone. In this presentation, I am going to discuss bull spread. It is a famous option strategy used by the option player when they see a breakout in the market and a market takes a up move. So here I will be discussing bull spread by using both call option and put option and how to make a bull spread along with the payoff table and the numerical on the bull spread. The first 3 points which you have to remember before making bull spreads are: point number 1, bull spread is a normal spread. It is not a combination spread. What does it mean? It means that bull spread is created either by using call option or by using put option. It is not created by using the combination of both call and put for a same option strategy. Point number 2, bull spread and bear spread are called vertical spreads. Why? Because in bull spread, we see the market goes up, and in bear spread, we see market goes down. So in both bull spread and bear spread, market takes a vertical move. Either it will go up in bull spread or it will go down in a bear spread. Point number 3, bull spread is created when a market takes a directional move. Now the important question that comes here is, what is a directional move of the market? So let's understand the directional move with monthly chart of Nifty. Here we see the candlestick chart. Each candle is a monthly candle. Here the market is showing a downward move. This was the fall of COVID-19 outbreak in 2020, and after a fall, market took some time to consolidate, and then market changed its direction and took a bullish turn. It was 7,500, touched the bottom, and then with the bull run, it touched the height of more than 18,000. So this shows a directional move from fall to a base and then to a strong upward move, that is called a bull run in the market. Let's see the weekly chart of Nestle to understand a directional move. Here we can see that at this point, market took a downward direction. It gave some time to accumulate and then it had a bull run. So this is called directional move. Here again you can see the weekly chart of SBI and Bank of Baroda. SBI, you can see first market take a downward direction, then it spent some time and then it took a upward direction. Here also market fell, it took some time, the basing period, it consolidated for some time and then it took a bull run. So this is called a directional move. Now let us see one more directional move on a daily chart of JK Lakshmi, where each candle is a daily candle. This chart shows that after a long accumulation, market took a bull run. It moved up vertically. So this chart, as we have seen from the monthly chart, from the weekly chart, or from the daily chart, we can see the bull run on all the 3 time horizons. So this bull run can help the option trader. Option trader can use these bull run on the basis of their trading style, whether they are a daily income trader or a swing trader or a monthly income trader, and can make money. So as we can see from the chart, when the market is taking an upward move, bull spread strategy is used to create money by the option traders. This bull spread can be created either by using a call option or by using a put option. Now let us see how to create a bull spread strategy using call options. To create a bull spread using call options, we have to satisfy following conditions. Condition number 1. It requires buying a European call option at a certain strike price of K1. Number 2. Selling a European call option with a higher strike of K2. Number 3. Both the buying and the selling of European call option should be done on the same stock. Point number 4. Both options have the same expiration date. As we are making a bull spread from call option, that requires an initial investment. First, we have to buy a call that is called a long call at a strike of K1 at a lower strike. Why we are buying a call? Because we are having a bullish expectation that market will go up. So if our expectation is correct and market took a bull run vertically up, our long call will earn for us. But what happens if our expectation goes wrong and market instead of falling up will go down? So we hedge our position by buying an opposite contract, that is a short call. So we short a call at a higher strike of K2. This profit of a call will be studied on the basis of the stock price at the time of expiration of the option, that is ST. So let's find it out with the help of the figure. Let us see a bull spread using call option with the help of this figure. So this is a profit and loss line and this is the stock price line moving from lower to higher level. We have two strikes, K1 the lower strike, K2 the higher strike. So since we are making a bull spread, we will start our trade with a long call. We will buy a call at a lower strike of K1 with the expectation that market would go up. So to buy a long call at K1, we have to pay the option premium and our trade will start with a negative balance. So the option premium is the amount which we have to pay to get a right to buy a long call at a strike of K. Now we expect that the market would make a bull run and the stock price at the time of expiry would go high. That will give us unlimited profit in long call. But what happens if our expectation goes wrong? Instead of moving up, market goes down. So in that case, we will also have a short call. We will short a call at a higher strike of K2. So as soon as we short a call at K2, our trade starts with a positive balance because we receive the money in a short call. Short call holder give the right to a long call holder the right to buy, and for that giving the right, he receives the money. So if the market instead of going up, it goes down, long call will expire worthless with a limited loss equal to option premium, and short call will have a limited profit and that profit will be equal to the option premium. So the total payoff strategy, the total profit can be seen with this green line, and the profit of the individual strategy can be calculated with the probable position of a stock price at the time of expiration. Either stock price would be below K1, the lower strike, or between the two strikes K1 and K2, or higher than K2. So before Moving into the payoff table, one thing you should remember, when you draw a diagram, always respect this king point. Your line should be king only at the strike. Here also, these option lines are king only at the strike. Never make it king before the strike or after the strikes. Otherwise, your figure gets wrong. Now let us analyze the payoff table. This is the payoff from the bull spread created using call. Here we have type 1, type 2, type 3, three probable position of a stock price range. This is the payoff from the long call option, and this is the payoff from the short call option, and this is the total payoff from long call and short call options. So first type is if the stock price is less than K1, somewhere here. Your payoff from a long call option will be 0, payoff from the short call option will be 0, and total payoff will be 0. If in type 2 the stock price is between lower strike and higher strike, your payoff from the long call is ST minus K1, but the payoff from a short call is 0, so total payoff is ST minus K1. Type 3, if the stock price is greater than or equal to K2, so the payoff from the long call will be ST minus K1, but a payoff from a short call will be minus ST minus K2. So this one, so total payoff will be K2 minus K1. So here what we have done, we have added both the payoff and what we have got the total payoff is equal to K2 minus K1. So this clearly shows that the most aggressive bull spread is type 1 spread. They cost very little to set up and have a small probability of giving a relatively huge profit of K2 minus K1. Along with that, as we move from type 1 to type 2 and type 2 to type 3, spread becomes more conservative. Let us see a numerical question on bull spread. So before making a spread, I request all of you to plot the strike price and the option price on the figure and then try to calculate the answer. Here in this question, we can see that the question is asking an investor buy a 3 rupee 3 months European call with a strike price of rupees 30. So our first strike comes here, rupees 30, at which we buy a long call by paying 3 rupees as an option premium. The next condition is, and he sells for rupee 1 a 3 months European call with a strike price of 35. So our higher strike is rupees 35, at which the investor hedges position and he take a short call and receives rupee 1 for creating a short call. Now look at the payoff. The payoff from this bull spread strategy is 5 if the stock price is above 35 and 0 if the stock price is below 30. If the stock price is in between 30 and 35 rupees, here the payoff is the amount by which the stock price exceed rupees 30. So your payoff will be whatever extra you receive beyond 30 rupees. So find out the profit. So first of all, we have to find out what is the cost of making this strategy. So the cost is rupees 2. Why? Because for buying a European call at a strike of 30, we paid 3 rupees. And for selling a European call, short call, at a higher strike of 35, we received 1 rupee. So our total cost of making this bull spread strategy is 2 rupees. Now let us see the payoff table, which will show you the profit when the stock price expire, the 3 probable positions of the stock price, and what is your payoff. So first position, when the stock price at the time of expiry is somewhere here lower than rupees 30. lower strike. So when the stock price is this range, your long call will expire worthless. You are not going to buy from the option market. You are buying from the open market at a current market price, and your option will expire worthless. Your loss will be limited to the cost of making strategy, that is 2 rupees. Because 1 rupees you have already covered by hedging your long call by buying a short call as well. Now when the stock price is somewhere in between this range, your payoff will be whatever you receive beyond rupees 30. So your stock price minus 30, the lower strike, and plus 2 the cost of making strategy. Your total payoff will be ST minus 32. Now the question says if the market takes a bull run, stock price at the time of expiry is beyond 35, your payoff will be, the payoff from this bull spread is 5. So here if the market goes beyond 35, payoff is 5. So what would be your total profit? Your total profit will be 3 rupees. Why? Because 2 will be deducted because it is the cost of making strategies 2. So 5 minus 2 is 3. The total payoff will be 3 rupees. After seeing a bull spread using call options, now we will see a bull spread using put options. Now let us see how bull spread is created by using a put option. So bull spread from put option requires following conditions. Condition number 1, buying an European put with a low strike of K1, selling the same European put at a high strike of K2. That means both buying and selling is done in only in European put option. The option on a same stock and same expiry. Beside this, it is important to know that unlike bull spread created from call, those created from put involves a positive upfront cash flows to the investor, ignoring a margin requirements and a payoff that is either negative or zero. So let us see the bull spread created from put option with the help of the figure. So this is the profit line. This is the stock price line. Starting from lower to higher, we have two strikes. K1, the lower strike, K2, the higher strike. Now in bull spread created from put, we will first take a long put position at a lower strike of K. So a long put holder expects the market to fall down at the time of expiry, and if the market goes down, the long put holder will have unlimited profit. But if the market goes up, the long put holder will have a limited loss, and that loss would equal to the option premium. Now to ensure the loss or hedge the loss, the put option holder will short a put. He will short a put at a higher strike of K2. That means he is bidding that the market would go down. But if the market does not go down, it would go up. And if the market would go up, the holder of a short put position will earn profit, which is equal to the option premium what he has received by giving a right to the long put holder. So this shows that the total payoff line is the inverted Z that shows total profit. So you will find your profit position by three probable situations of the stock price. Situation A, B and C. So now you have to be very clear and very cautious when you draw a figure. Your kink of an option line should be at a strike price. So this figure is very interesting where I have taken both the call and a put used for creating a bull spread. So if you see total profit, you find a same figure, inverted Z. So it is something like this, and then price goes up, it's make a profit and then stop. So here long call means buying a call at a low price, selling a call is a high price and earns the profit. If we see put, buying a put at a low price, selling a put at a high price, and then it earns a profit. Before concluding this presentation, let us again see the charts what we have taken in the beginning of the discussion. We have seen all the monthly, weekly and daily chart, and we have find out the direction of the trade. Now after studying the bull spread and the shape of a final payoff or total profit, we can plot this shape of inverted Z on this figure. So it goes like this, a long accumulation, bull run and then stop. Market goes for long accumulation, took a bull run and then stop. A long accumulation, market took a bull run and then stop. So there this shows the buying at a lower strike, selling at a high strike, buying at a lower strike, selling at a high strike, buying at low, selling at high, buying at low strike, selling at high strike. So these charts, as we have seen, that after a long accumulation, market took a bull run, it moves up vertically. So these charts, as we have seen on a monthly, weekly, daily, we can see a bull run in all the 3 time horizons. So this bull run can help the option traders. Option traders can use this bull run on the basis of their trading strategies, trading styles, whether they are hourly income trader, daily income trader, swing trader or monthly income trader, and can make money from the market. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.